Hi everyone, this is Emily and I'm a digital transformation consultant at Hyperbots. I'm very pleased to have Rick on the call with me, who has been a CFO for a long time and has been into finance across different business segments, different industries, and different revenue streams. So, really happy to have you on the call with us, Rick.
Thank you for having me. It's a pleasure to be here.
Of course. So, Rick, the topic we'd be discussing today is liabilities in chart of accounts. And just to get things started, the first question that I have for you is what role do liabilities play in a company's chart of accounts, and why is it important to structure them correctly?
So that's a very important question because liabilities are, sums of money or obligations to third parties,
Mhm.
and they represent a very important part of the business and has a lot of significance for managing the business as well as reporting on its, financial health. Correctly structuring the liabilities is a really important topic, and not just for accurately reporting the financial status of the business, but also for internal reporting. It can have implications on lender covenants and a lot of other financial parameters.
So, Rick, would you be able to provide some practical examples of how liabilities differ across the different industries, let's say across manufacturing, retail, or SaaS, really?
Certainly. I think different industries will have different kinds of liabilities. For example, in the manufacturing industry, you would have accounts payable and obligations or money owed for raw material purchases and services. For retail, there would be similar obligations for goods that have been bought. In addition, there would be lease liability, and in a SaaS industry, you would have liabilities for deferred revenue, those kind of
Mhm.
expenses, and maybe in certain cases liabilities for other expenses.
Got it. So, what are the best practices for structuring liabilities in the chart of accounts to ensure clarity and compliance?
So some of the best practices to ensure clarity and compliance is, like, you need to pay attention to classification. You have long-term liabilities, you have short-term liabilities, or as they're called, current liabilities.
Mhm.
And within certain long-term liabilities, you would have obligation to identify the current part of that liability. You would require a little more specificity in terms of the nature of each liability. Some of them may have to be revalued, so you have to
Mhm.
take that into account. That you should ensure consistency, just consistency between the way that different liabilities are treated across maybe the entity. If it's a multinational or a multi-unit entity, you have to ensure that it is this thing which will make consolidation easier. There should be some transparency. Liabilities need to be broken out with some degree of, let's say, specificity, so you're not clubbing two different kinds of liabilities, and it becomes reporting and analyzing information easier. And then lastly, I would think you need to review them regularly. So it will be a good idea to just make sure that your current designation is accurate.
Got it. So, I understood the best practices. What are some of the common mistakes or, let's say, errors that accountants often make when structuring liabilities in the chart of accounts?
So common mistakes that I've seen people make is maybe an improper classification. There could be the risk of over-aggregation, that under GAAP there is a certain requirement for disclosing certain liabilities, and then it may be okay to aggregate some smaller amounts, but significant amounts need to be reported separately. You could have a situation where you have redundant accounts. You would obviously want to avoid redundancy, and then inconsistent terminology, and the most significant is you could even omit certain liabilities.
Makes sense. So, Rick, how can AI help in improving the accuracy and management of liabilities within the chart of accounts?
So AI, as I like to call it, is augmented intelligence, right? It is anything. It is rule based. It is machine learning. It is all of those great promises. And the biggest sort of benefit that AI can bring is an automatic classification. It should be possible to automatically classify liabilities based on certain examples. If you have a lot of volume, anomaly detection should be another benefit. So, for example, if you, let's say, think about accounts payables, you can detect anomalous patterns, you can detect things like that. It will make controls over some of these items a lot more easier. You can use some of this to even drive standardization. So, standardization could be another benefit. And with all of that, probably the biggest benefit that you can have is predictive analysis. You can use some of this data and patterns to help you with cash flow forecasting, just forecasting a lot of other things in addition to maybe anomaly detection. And then lastly, it would just be dynamic updates. When certain things changes, you can have probably rules that will advise you that, a change is required. So there is a lot of promise that AI holds in terms of management of liabilities.
That's really amazing. Can you like share a specific example of how AI has been used effectively to manage liabilities in a particular industry per se?
Yeah, I can think of a couple of industries, but let's take healthcare for instance. AI has been used to automate classification of liabilities, like I said, between accounts payable and accrued expenses. It is used to analyze historical data. It's used to detect vendor anomalies, all of the other things that we spoke about, and also flag unusual spikes in payments. This has helped generally healthcare providers better manage their business as well as analyze or flag potential errors.
So, Rick, how exactly can companies ensure that their liability accounts remain flexible and adaptable to changes in the business environment?
So the biggest thing that you can probably do is to make sure that you are constantly reviewing it, reviewing all your chart of accounts to make sure that missing any new liabilities correctly identified. As I mentioned, in some cases you would have to break out the current part of the long-term liability. So those are important things that companies need to be doing on a continual basis.
So, just to wind things up, Rick, one final question that I'd want to ask you is what advice would you give to CFOs and finance teams about managing liabilities in the chart of accounts?
My advice would be to finance teams to continually focus on providing consistency, clarity, and accuracy in reporting of liabilities. And they should really be embracing technology, artificial intelligence, and automation that will help them consistently review their liabilities and ensure that their financials are being reported on an accurate basis.
Thank you so much, Rick, for these valuable insights on managing liabilities in the chart of accounts. Having you was truly amazing and it was a very fruitful discussion.
Thank you for having me. It was a pleasure sharing my thoughts on this topic.